Now, before we get into segment 2, where we look at refined products and really kind of project what we think is going to happen with demand going forward, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So before we get into the nitty gritty on the different pieces, let's look at U.S. product supplied as a whole. Right now, we were at 13.8 million barrels as we look at gasoline, kerosene, distillate, residual. And as we were saying, we were going to tighten up in terms of, instead of having these big highs and lows, we thought we were going to start to firm up a little bit as we head into the remainder of the year. And you can see, just where we sit versus 17, 18, and 19 as those demand numbers continue to kind of flatten out. And as we look going forward, we think they're going to continue to roll over. Obviously, we'll have a little bit of a bump due to driving for the holidays, and as diesel demand increases in terms of moving stuff around. But again, these are things that we think is just going to remain, and again, not moving to the lows from April, but really moving closer to the 13 million range as we go through the remainder of the year. So now that we can kind of go through some of the different pieces of it, I think it's important to really appreciate where we sit as a whole going into the remainder of the year, looking at diesel. So you can see that we had a draw of about 1.44 million barrels. And it was really driven by Pad 1, which by Pad 1 being the East Coast, which makes sense if you consider, we're starting to see some heating demand. But one of the interesting aspects that we've seen, just given based on COVID and what's happened overall, we're seeing a big drop in demand in Europe, which is essentially flipping the arbitrage. So typically, we import gasoline from Europe once the arbitrage makes sense, and we export diesel. Some rare times there will be opportunities for Europe to export diesel, but that arbitrage has remained fairly open for now. I think we're going on about 14 to 15 days, which is unusual, but not surprising given where we sit in diesel storage and where they sit in diesel storage and how that's going to balance out. So we actually are going to see a pretty healthy import of diesel into not only just Pad 1, but also Pad 3 from Europe, which will start to show up and essentially pad some of these stock build and draws numbers. Now, we're starting to see an increase in yield, obviously Pad 3 and Pad 4, and you can see it in the production numbers. So the yield is increased by about 1.4%, which is about 333,000 barrels a day. Again, they're not perfect numbers. It's more of an estimate. And Pad 3 is obviously the biggest driver. Again, Pad 3 has seen the most increases in refinery utilization rates. So now we're seeing a bigger cut of diesel, or distillate in general, as we see, again, those more imported heavy crudes, a shift to increase that diesel side and distillate side, just because here you can see that we're a bit more normal in storage. Now, going back the last 30 years, you can see clearly we're still above average. And the problem is the pace of those declines is starting to flatten out. And we should start to see not so much increases, but the slope remaining a problem as we have a targeted yield, as we see some demand slowing down, and as those imports increase and exports remain under pressure. So the one request that we did have, so typically we've looked at this on a 30-year chart, and it was requested that we look at it on a 5-year chart, which is fine. You can kind of see it's a little bit lumpier, but again, you can kind of compare apples to apples, especially as we normally do the 5-year with gasoline and jet fuel. So here you can see we're still above average. It's still within the top of the cloud, and we're trending in the direction that we normally trend in. And it's important to appreciate, as we start to talk about where we think demand is going to go, we're just saying it's going to follow the seasonal path, but it's still going to remain above the 5-year average, just because we do have elevated demand into trucking, into rail, and the biggest headwind is really, as we look into December, the heating degree days and heating demand days, just as they're just not. December is going to continue to be warm. We had a warm November. We're going to have another warm December. And when we look at exports continue to struggle, which is going to impact and impede some of the demand numbers that we're seeing within the U.S. overall. Now that we said trucking, as you remember, we've said 95 to 105. And here we are. We're at 97 so 90, almost 98 essentially. It's just we're just going to remain again in this confidence range. Not surprising when we look, refrigeration rate increased. Birds, turkeys, and everything else has to be refrigerated. So again, when we think of an increase of everything from fruits and vegetables ahead of the holiday season, again, not surprising. The thing that when we look out gives us confidence that we're just going to stay within this range. Again, we just look at the truck availability, which is starting to increase a little bit, load availability, which is remaining fairly flat. These are the types of things that we're just going to continue to go sideways. This is only looking at essentially the past year, just because we wanted to show, as we've shown in previous ones, over the 5 year, that this is a massive increase versus the previous high of 2018. So now it's just a matter of, where the change is really coming in. And that's why we just think that we're going to remain sideways. But being sideways at these levels is still a big demand driver for diesel, which is going to be an inherent tailwind as we go through the remainder of the year, because this is not something that's going to pare back over time. So now that when we dig into some of the rail data, the car loads were down 7.2% versus last year. And as we were saying, the grains was normalized a bit. So as we said, like last week, it was 30%. The week before, it was up 23%. Again, it's just something that as we get past now, I think at this point, we're at either 99 to 100% done with the harvest, depending on where you are and what you're harvesting. And that's why those things are going to continue to be a decline. But because we do have such strong demand on an export side, you're going to see some of that balancing act, which will keep the grains moving, hopper cars employed, and it's just really going to be going from the silos to the coast, just to kind of move things through the system. Farm products, excluding grain and food, everything farm is going to remain fairly strong. Again, it's just more of a normalization. As we said, metallics, motor, all of that continues to be under pressure, also with petroleum and petroleum products. All of those things are going to remain weak, at least weaker versus last year. And there's nothing to really say that it goes up or down. We think it's just going to kind of go sideways. The biggest surprise remains and has continued over the last 2 weeks is intermodal. Intermodal was up 11.5%, which is an increase versus last week. As we said last week, we expected it to start to come down either this week or next. It's always going to come down to timing. When do those cars get to their destination? And as we go into the Econ show, there's a big bottleneck specifically in California, which is going to keep some of that activity fairly stable. And when we look at ports, so typically in California, as other places, due to fire hazards, you're typically not allowed to stack more than 5 containers on top of each other, because if they fall over, what is the fire risk if they to get in? And these are some of those little things that come into play, and there's a lot of those bottlenecks, which is going to keep intermodal a little bit higher than what we were expecting, just given some of these issues at the coast. But it's also going to be supportive of trucking as well. So we still think intermodal starts to normalize, but it's going to be still along those seasonal norms. It's just going to remain elevated. As we go year to date, we're still down 3.4%, but again, that's going to continue to get eaten away at as intermodal units remain strong going into the end of the year. It's just, the strength. Is it going to stay at 11.5%? I'm going to say no, but again, it's something to watch. Which, net puts total traffic up about 2.5%. Again, these are just very strong diesel demand numbers for the rail industry. But when we look at petroleum and petroleum products, that gives you an indication on some of those headwinds that we continue to see on demand, as we're just not seeing that product and that oil move through the system. Oil being moved by rail car, obviously that's mostly Bakken. So again, as we've talked about, Bakken frac spreads were slowing down. That's something that we think continues, and here's some of the additional proof for that. Now, as we go into, shifting gears a little bit into gasoline, here you can see that we had a build of about 2.2 million barrels. Again, it was pretty much a build across the board, nothing too crazy in terms of where. Pad 1 had a little bit of the largest increase of 1.12 million. it's going to be timing with those imports from Europe, as we started talking about 2 weeks ago when the ARB really started to open up. And that remains the case, and it's really going to show up in pad 1 mostly. Some of it will end up into pad 3, but really pad 1 is going to be the landing point, which is going to take us above year over year and the 5-year average, which is going to pad some of these numbers. Now, we should expect a little bit of a draw next week as we get some backfill, and we'll talk about gas buddy data and some of those timing delays. But here you can see that typically we normally get an increase in builds. It's just they're seasonally adjusted all-time highs as we go up, looking over the last 30 years, and it's just going to continue where we're going to maintain the seasonal trend. It's just going to remain well above where the top of the cloud, really setting those new records going forward. And it's really being driven, as we've been talking about, we were expecting lower highs, lower lows. We got one again where it's a lower low as we go into this week. You may be surprised to know that this week this will increase. It's just going to be, it's something where we think it'll be below that 8.6 or so. It'll be closer to 8.5, 8.6 on the lower end. And then we think that as we go into the end of the year, is this going to be a super spreader event? Is this going to be a bigger issue going forward? That I think is going to have a bit more to say as time goes on and we start to see case counts. What are hospitals doing? What is infrastructure looking like? But again, we're just following the trend, and we think that there's going to be a weaker than normal increase in demand year over year, obviously, but then week over week, it's still going to increase, just not by the amounts I think the market is hoping for. And when we say that, we just look at some of the 7-day moving averages, some of the expectations going forward. So here you can see grocery stores, everything remaining kind of stable to slightly down. Not surprising with parks, given the weather. Grocery is going to see a little bit of increase, obviously, for shopping. But again, transit, workplace, retail, recreation, all of it is trending in the wrong direction as we go, and we kind of expect what's going to happen on driving demand going forward. Apple mobility data, everything's kind of normalized a bit in terms of Germany, UK, Italy. We have the chart, but I unfortunately forgot to include it this time. We had a small increase of about 2% in net European driving. We're still down anywhere about 33 to 37% based on whichever country we're speaking about. Macron is talking about increasing, opening up the country from the lockdowns December 5th. The UK is going to go back to a regional instead of a national. So these are things that will start to normalize some of that throughput. Again, as we said previously, we weren't going to get to those April levels. It's just we're not gonna see those same type of lows, and we're not gonna see the same type of highs as people look to mitigate, in person and indoors, just given where we sit on the COVID scale. We've seen U.S. slow down a little bit, up 8%. We were up about 4% previously, again, as people are just searching and looking to get where they're going to go, because everyone knows that they can't drive without Waze or Apple Maps or Google Maps, just given the real-time traffic data and trying to get around the holiday traffic. So as we go into and look at the weekly gasoline demand from Gas Buddy, it's up 3.7% last week. And again, just think about timing. So when you're going to drive, you're going to obviously go fill up the tank. So this is looking at it at the pump, because they're looking at the data they're collecting when you pay. So what does this mean? This means people started to fill up their tanks last week, and then not surprisingly, they increased the amount of gasoline they purchased on Monday and Tuesday of this week. So gasoline demand rose 6.7% this Tuesday, setting a new pandemic high for a Tuesday. Week to date, gasoline demand is up 2.8% from last week. So again, we were up 3.7% last week. We're up another 2.8% so far this week. And again, people are just going to fill up. Maybe you haven't filled up in 2 weeks and if we look at previous Gas Buddy data, we've had a continuous decline when we look over the last 7 weeks or so. And when just kind of lining things up, they were up about 3.75% last week versus the 3.1% decline the week before. This is all just timing. So because an increase of purchases happened at the pump, that means that there's going to be a backfill, which means that there's going to be an increase in gasoline demand that the EIA will show. Now, Descartes Labs, they showed a decline of about 1%, which is now the sixth straight week of declines. And their movements are based on cell phone data. So again, the cell phone data is picking up when you're actually driving. So I would expect now, just based on where we're going, gasoline demand from a gas buddy perspective will come down this week, net when we look at the whole week, and Descartes Labs will show an increase just because people are going to go be driving, again, coming down to these normalizing views, which is why we like to take in multiple data points to understand, okay, where are we in the demand cycle, and try to get some of that predictive nature as to where will we see, and then how will things shake out over the next couple weeks. Again, the sixth straight week of decline in Descartes Labs, Gas Buddy outside of last week, about 6 weeks of declines, 7 weeks of declines, is just showing on what we should expect as we get past Thanksgiving. And it's just going to be disappointing as gasoline demand continues to weaken through the end of the year. Now, COVID net change cases, we've shown this before. The U.S. continues to remain at a high. Worldwide, they continue to grow. Nothing really is surprising here. Europe is past the peak, which is nice to see, which is why we're starting to get announcements on rollback of lockdowns. That will continue now that they've gotten ahead of it. The bigger issue, which is something that we've been talking about, is India cases. So you can see that the Indian cases went down, and we're like, look, they have festive season. The festival season goes for about 30 days, and then ends with Diwali, and here we are. So now not only did you get a delay in reporting just because people were on vacation, but now you had people going to parties and seeing family, and that's why we're now seeing those increases in cases, which is going to be concerning as we head into the end of the year, because they have seen an increase in gasoline demand. They have seen an increase in diesel demand. But how much will these cases really start to impact kind of that go forward level, which is why we look at high frequency data. Now, this is obviously as of the 15th, so this doesn't include the increase in cases just because just timing delays. But when we look at the overall aggregate, we have to look at the congestion index. So you can see the congestion index is starting to worsen a little bit. Now, it's one where we want to look at, because you want to get back to that zero. You want to get back to something that's a little bit better. And here you can see that it's moving in the wrong direction overall. And when we look at it now, it's closer to about 35. So we are seeing more driving, but again, that's starting to slow down. And the lockdown index is also concerning because the lockdown index really hasn't adjusted. And now with the increase in cases, there is that risk of seeing those tighten up a little bit. Again, not to that 81 and tighter, but something closer to the low 70s. Just as some of those things adjust. And then again, consumer indexes are starting to weaken a little bit. And this is going to be an interesting one to watch as we consider refined product demand and what does the world really look like. Looking at those daily activity indicators. As we've said, we expected that rollback in European activity, but as we said last week, it was going to really kind of flatline and just go sideways, and we're really starting to see that happen in Germany, in France, and a lot of these other regions. Now, the issue is, again, we don't see it going higher. We think it's just going to continue to go flat, which is going to put pressure on Q4 GDP as well as Q1 2021 GDP, which is something that we're going to talk about and cover in more detail on the economy show. Now, looking at jet fuel, really nothing to say here. There was a small draw of 160,000 barrels. The jet fuel, as we were saying, there was going to be an increase in demand. It's, again, lower highs, lower lows as we get past this period. And when we look at, well, why did we see an increase? Well, there's always an increase in passengers. So we did cross the 1 million mark twice. As we go, back and forth, you can see that we normally see those increases as the bumps match with last year. It's just that we're going to have higher lows. We're going to have not so much higher highs, but really kind of holding this 1 million mark as people just move around and get a little bit more comfortable with flying as they go forward. It's something where as we get past Thanksgiving, we think it's just going to continue to move lower as we go through the remainder of the year. And now as we look out into flight departures, we did get an increase. Obviously, we have more flights leaving for Thanksgiving. China and the U.S. remain the kind of the bright spots. You can see Europe remains fairly depressed, and we've seen more flights actually get canceled. That will start to adjust. Some of those flights from the U.S. will go away next week and the week after, obviously holiday. China is going to be the one to watch because China is starting to see a little bit of an increase, and that will remain as we head into Lunar New Year and the week off that a lot of the Chinese enjoy, especially as we head into the lunar part, which is again coming into why is China buying now? Why are they buying so much? Things that we'll talk about in segment 3. Open table. Nothing surprising here, moving in the wrong direction just as we get lockdowns and renewed curfews. And when we look at it across the globe, you can see open table regional. As we said, we thought we were going to go to about 55% down on average, and we're right within that ballpark, maybe closer to 57% at this point. But again, just kind of splitting hairs. Australia, New Zealand, 0 new cases, 0 spread. So we're seeing that remain fairly stable. Canada, Germany, Ireland, pressure is going to remain. UK, again, it's going to come down to the regional side because some of the regions are, we're moving a little bit further away from national lockdowns to more regional lockdowns, and this will start to see some increases. The U.S. is going to continue to slow, again, weather-based, and those will start to offset. But we think we have at least one more week of depressed activity, especially at the restaurants, and then things will start to get a little bit better as we look at Germany, Ireland, and the UK going forward. Rounding it out, MTA entries, and looking at just urban movements, you can see now the 7-day and 50-day moving average are flat line. There's really nothing to say here. We're just going to continue to go sideways. We'll have our seasonal adjustments, but again, nothing really indicative that we're getting a big mark shift one way or the other. It's just kind of steady as she goes as we look into the urban setting and people kind of remaining at home instead of going back to work, which is just going to be some of those issues remaining and continuing to worsen as we look out at the aggregate of total refined product demand.